Hi, and thanks for joining us for this quick introduction to Ecora resources. So at Ecora, our reason and purpose for existing is really quite straightforward. On one hand, in terms of our portfolio today, we have an opportunity to create a royalty business, which is highly concentrated and focused on those commodities which are required in some capacity across the energy transition thematic, which includes renewable energy production, the transmission of energy, as well as the consumption of storage of energy. And from here, our strategy is to continue building out our royalty portfolio by continuing to acquire royalties over operations that are or expected to be low-cost operations with strong management teams in well-established mining jurisdictions. And we believe that as we continue to scale up our business, Ecora will offer something that's fairly unique, and that would be a relatively de-risked way to get energy transition commodity thematic exposure via the royalty model. And the royalty model, as I just mentioned, is relatively de-risked compared to a more typical mining sector investment. And that's because as a royalty company, our exposure really comes off the top line. Our exposure is a function of production, and it's a function of realized commodity price. And as a royalty company, we do not have direct exposure to operating costs or to capital costs. The consequence is that as a royalty company, typically, the royalty company will see less volatility and therefore can take away some of the higher beta risk that exists in investing directly into a mining company relative to a royalty company. And of course, the second thing that's very interesting about the royalty model is the fact that because our exposure is at the top line, and because as a royalty company, by virtue of not having any mining operations, we have a relatively low fixed operating cost base. The business model is well positioned to insulate any investors from price inflation. And in fact, if you look at copper price 20 years ago, copper price was around $1 per pound. Today, it's around $4.50. And if you had a royalty 20 years ago, you'd be at 1%, you had 1 cent per pound. Today, you have 4.5 cents. So it's a really, really interesting model in that sense. And we don't know what the copper price will be 20 years from now. But if you continue to have a royalty and you extrapolate that price inflation forward, that increase purely on a nominal basis really flows down to our bottom line as a royalty company because it's not offset by higher operating cost inflation, for example, and it's not offset by higher capital costs. So it's really, amongst other, some of the key benefits of the royalty model. And so zooming in here to discuss Ecora, as I mentioned, our portfolio today is approximately 96% OECD in Brazil, which is a very well-established mining jurisdiction. Our principal exposure is to Chile, Australia, and Canada by country. And by commodity, our cornerstone exposure as a percentage of asset value, our number one commodity is copper. And that percentage is expected to grow further as we get closer to first production and unwind discount rates from some of the copper assets in our portfolio, which are currently getting closer to production. From there, cobalt is our second largest exposure. That's a singular exposure, the Voisey's Bay mine in Canada. We have nickel, uranium, vanadium, amongst others. And we've built this portfolio in a very deliberate and methodical way. We've really sought to build it by building up exposure to, as I mentioned, operations that are well positioned on global cost curves. And you can see the bottom pie chart on this page demonstrates when you look at our key assets in our business, the vast majority, approximately 84%, are located or are estimated to operate in the first or second quartile of industry cost curves, which we're really happy with, and we are very keen to see that continue into the future. We've built our portfolio again with reference to seeking out strong counterparties who are well capitalized, who have vast experience running and operating mines. And we've seen as a virtue or as a function of our increased disclosure, substantial improvements in our sustainability risk assessments, moving from a few years ago, relatively higher risk, For example, to today, it's Sustainalytics being deemed low risk and seeing another upgrade last year, which is great. This is a very quick overview of our producing royalty portfolio. And I think what's really interesting about Ecora is that even though Ecora itself is a small cap company, the folks who are operating the mines are not. If one were to take the market capitalization of the counterparties operating or producing portfolio and sort of add it together for those who are public, the total market cap is approximately $200 billion. And so Ecora offers small cap trading risk or liquidity risk by virtue of being a small cap, but it doesn't actually materially, for producing assets anyways, offer small cap risk in terms of the classical sense in the mining sector, where small cap risk is typically means a single asset, financing risk, these types of things. So it's a nuanced distinction, but it's one that we always are keen to point out. And this is really the future of Ecora here on this slide. And our development pipeline at its core is functioned in copper, nickel, and primarily in two assets: West Musgrave, a BHP asset currently in construction, and secondly at Santo Domingo, owned by Capstone, and an asset that, based on latest guidance from Capstone, would be final investment decision would be targeted at some point next year, which could see first production as soon as 27, 28. This is a really interesting slide because it allows one just to look at where the business is today and take stock of where it was and where we think it's heading. So one of the first things to note on the top left corner of this slide is our revenue mix. And for anyone who's been tracking this company for some time, they should be aware, and back in 2015 or 2014, this company was effectively concentrated in one asset and one commodity, and that was the Kestrel mine. And the Kestrel mine has been a great royalty. It's a met coal royalty that's done really well, and it's allowed us to reinvest those cash flows in a very accretive way. But like any good thing, the Kestrel royalty, we've always known, would approach the end of its mine life in 2026. The mine will continue to operate. It's just our royalty will stop generating royalty income, simplistically because the mineral resources contained within our royalty area will be depleted. And so, going even as far back as 2015, we've always had this need to reinvest cash flows to position the business first to generate income beyond Kestrel, but two, to diversify our commodity mix exposure beyond Kestrel as well in the intervening periods and then thereafter. And then third, to reposition our portfolio. On the right-hand side of this slide, you can see actually, if you look back at 2015, the vast majority of this business's value was concentrated in that Kestrel coal royalty, 83%, with actually very little to come afterwards. And that was really the first challenge, in that to have so much of our portfolio concentrated in one producing asset meant that, for lack of better words, the hopper wasn't sufficiently full thereafter to organically replace Kestrel. And so the first phase of our strategic imperative was to buy producing royalties, such that when Kestrel ran out, as we knew it would, while we might not have, the exact amount in total, we could have, we feel like now we've replaced the through the cycle annual contributions from Kestrel from the rest of the portfolio in producing assets now. So in other words, loosely speaking, one could expect a one-to-one type of replacement, assuming through cycle commodity prices and average mining production rates, which was great. But the next phase beyond that is to go and fill the hopper, as I had mentioned. And we feel like today, where we sit, we just have a much healthier portfolio exposure. So we have approximately half of our portfolio in producing assets, 16% in construction assets, thereafter 27% in assets that are very close to production but not yet in construction, and then at 4% longer dated royalties. And so from here, we feel the first phase has been to recast the portfolio composition. The next phase is really to add more depths. So in other words, we have today many more producing royalties than we did in 2015, but that's not as good as having, twice as many as we have now, for example, in terms of having a more highly diversified producing royalty basket. We have one construction stage royalty. That's not as great as three. And, we have a handful of really important near-term development royalties. We'd love that to be a larger number. So it's a complicated and long-winded way of saying that we feel that our portfolio exposure by stage of development now is roughly correct. And we feel that the key to take this business forward is at maintaining roughly that balance, but just adding much more diversification. And this is a portfolio that we've accumulated, which, if you look at this slide on the dark blue line, gives you a feel for what our producing portfolio of non-Kestrel royalties generated last year is expected to generate in 24 and 25 from broker consensus, and then thereafter in the medium term, a sort of, a consensus forecast from research analysts. And what you can effectively see next to that is a Kestrel contribution that's expected, that was generated in 2023 and expected in 24 and as well as 25. So what this slide should demonstrate, or we're hoping to demonstrate, is with the portfolio we have now, but just based on the producing assets, we do feel as though the business can generate a good level of income such that when Kestrel approaches the end of its life, we have a stability from the producing portfolio in terms of the revenue line. And thereafter, incrementally, we've tried to break out the various sources of growth in the business from a potential revenue contribution. So the first is potentially from West Musgrave, which is currently, well, as of earlier this year, 21% complete, subject to BHP further indication on timing of first production date on that asset. We have a better feel for whether that's 27, 28, earlier or later. But in any event, purely from an illustrative perspective, that's the sort of level of annual contribution one could expect from that asset at current long-term consensus commodity price forecasts. And then in addition to that, in the orange line, you can see the contribution from assets in our portfolio that are near-term development. That includes Santo Domingo copper project owned by Capstone Copper. That first production date, as I mentioned, is targeted 27, 28. And then in addition, Piauí, again, targeting first production in 27, 28. So the portfolio we have today, excluding Kestrel, based on current forecasts, has the ability to generate through cycle approximately $50 million a year from the producing basket. And then with the near-term growth in the business has the potential to exceed 100 million per year. So this is a really exciting outcome for this company. It's really a story of incremental acquisitions, considering the challenge we had 10 years ago, where the exit from Kestrel is not a choice. We haven't decided to exit Kestrel. That royalty simply will be depleting. So we feel at this stage, created a platform that we can build on. And frankly, that requires much more diversification. And so today, this slide gives you a feel for what's priced into the equity today. And for a variety of reasons, the equity today appears to be trading at a discount to the producing asset portfolio, which is unusual. But it's something that we always flag to potential investors, in that at today's entry point, one can capture approximately the value, enter around the value or slightly less from the producing portfolio, as estimated by brokers or research analysts, and get a lot of all the other assets in our business for free. Who, in other words, buy at the price of the producing basket and have the optionality, although we would argue that it's worth more than option value, of the development basket as upside. And when we look ahead to the future and we think about the Ecora value opportunity, we've broken this into two for simplicity, but we think there's two sources of growth. The first is just organic growth. So in other words, what would happen to this business if we just took our current trading multiple and then assumed that the growth that's expected to come is delivered. And that would creates a potential for a doubling of enterprise value in time. And what's much more interesting, we think, is the potential for multiple expansion. Today, a good chunk of our portfolio contribution continues to be generated as a result of metallurgical coal or steelmaking coal cash flows. And when we look at how equities trade, specifically, I mean, comparing a base metals equity or a steelmaking coal equity, generally speaking, the steelmaking coal equities tend to attract much lower trading multiples, whereas a base metals equity typically attracts a much higher trading multiple. So what you can see on the right-hand side of this page is our current trading multiple and what that implies as a percentage, as an implied enterprise value. And what would happen theoretically if Ecora were to re-rate to the trading multiple of our closest non-precious metals royalty peer, which currently is trading approximately 20 times. And you can debate whether or not these trading multiples are the right metric and representative of how royalty companies should trade, but purely for illustrative reasons, we're keen to highlight the point that there exists strong potential for the trading multiple to expand as and when our cash flow, the complexion of our cash flow changes from what's historically been steelmaking coal to base metals in the future. Earlier this year, we updated our capital allocation framework. This required a lot of thought and was a very difficult decision to make because, a good portion of our shareholder register were very focused on cash returns. And we felt that given where we are in the commodity price cycle and the opportunity to grow this business, and given we feel that to be successful in the royalty model, one of the keys really in our view is to acquire royalties at attractive cyclical entry points. We see a lot of price volatility. We've seen copper go from at lows of $2.20 to recent highs above $5 per pound. And therefore, as successful as one is in terms of their due diligence, in terms of selecting counterparties, obtaining the right entry points is probably the most important determinant of success in the royalty sector. And therefore, we feel that today is the right time to be deploying more of our capital to growing and diversifying our royalty business rather than returning capital, such that growth at this moment is our key strategic imperative. And thereafter, maintaining a strong balance sheet is equally important on the basis that, as we mentioned, we feel a key to investor interest in Ecora is the company's ability to provide de-risked exposure to the mining sector. And therefore, by having too much financial leverage, one can erode what is otherwise a key attraction to this model. We have maintained cash dividends, and those would be calculated semi-annually and distributed semi-annually with reference to the free cash flow generation of this business within a range of 25 to 35%. And we've also introduced a fourth element as part of this framework, which is to consider share buybacks in the event that market prices materially diverge from estimated net asset value. And most recently, we completed a US dollar $10 million buyback program, which saw us repurchase just under 5% of our share capital. Earlier this year, we completed a successful refinancing. The financing. There's no change in terms of our key lending banks, which are Canadian banks, Scotia, RBC, CIBC, who have been very supportive of this company as we've grown it over the past decade, and furthermore are amongst the largest lenders to the royalty and streaming sector in the world. So therefore, we feel we've got a great group behind us. We have financing flexibility to continue to grow, and the company is well positioned to upsize that facility should we need to further grow the business. This slide will provide an overview of what and how we think about acquisitions, both in terms of commodity mix as well as sizing. So our key strategic priorities remain: number one, to keep base metals as the core of our portfolio, in particular copper. And number two, we're keen to infill and broaden the commodity mix. So you can see on the right hand of this slide the commodities that we consider, and we've highlighted those where we have current commodity exposure. Our focus, though, as I mentioned, is to keep copper at our core and infill from there. In other commodities where we have no exposure, like lithium, for example, we would like to have that in our business. At the margins, if we could have a small rare earths, graphite, high purity manganese exposure, that would also be great. And we do feel that as we continue to infill the commodity mix, Ecora will hopefully be perceived as, really that one-stop shop to get all that future-facing exposure in one equity, which is otherwise quite difficult to diligence and to track down. There, of course, are major miners, and then there are large producers of copper. But as one kind of goes through the universe of the future-facing basket, it's more difficult to find de-risked exposure to producing assets, for example, or to get the exposure as part of a diversified portfolio. In terms of the transaction sizing, at this time we're considering opportunities that are, in terms of producing or construction stage, greater than 25 million or more. The largest acquisition we've done in a producing royalty is 205 million. But as we go down that list, in terms of projects that are at study stage, advanced, but not quite at the final investment decision stage, we size those in the $10 to $25 million range. And then for those studies that are earlier, $10 million or less. And we feel that with this sizing, it'll help us ensure that we maintain the portfolio weighting we have to primarily producing royalties, as well as construction, near-term development, and earlier stage. So there's a lot. 2024 is a very busy year for us over at Ecora, and there are a number of things that we've been watching very carefully, as has the market. And the first one is the Voisey's Bay ramp up. So Voisey's Bay is a producing royalty in our portfolio, and 2024 is a very important year in that this project is approaching the end of its project schedule, and we anticipate to see ramp up in volumes really in the second half of this year, but more materially in 25 and onwards. So by the end of the first half, we should have a good feel for how that ramp up has gone in the first half of the year, but also when to expect to see these volumes ramp up and the pace of the ramp up in 24 and 25 afterwards. Just to give you a feel for what we mean by that, this year we anticipate volumes in the range of 12 to 16, I believe, deliveries of cobalt. That figure is later in the presentation, so we can get the exact figure for you. In any event, that figure, which is sub 20 at full production, has the potential to deliver 40 through cycle on an annual average once fully ramped up. So at Voisey's, there's strong potential for much greater volumes. At West Musgrave, this is a BHP asset currently in production, and BHP has recently indicated that they are considering a slower project execution timeline and a phased CapEx spend. The project was initially contemplated to achieving first production in 2025 or 2026. We'll hear from BHP. BHP has indicated that they will release further guidance on the timeline as part of their half-year statement. That's expected in August. So we should have a much better feel for when we can anticipate first production at West Musgrave within the next 2 months. And over at Santo Domingo, imminently a new feasibility study, an updated feasibility study is expected. And that should really give a much better feel for project economics. Capstone have alluded to project economics, which should have improved versus the prior study, which is impressive in the context of capital cost inflation. And this asset currently is being targeted for a final investment decision in 2025, which could see first income, as I mentioned, in 27, 28, excuse me. Mantos Blancos, we anticipate volume growth in the course of this year, particularly in the second half, and thereafter there's potential for further expansion of that project in 25. And of course at Piauí. Piauí is one of our key growth assets, nickel, cobalt located in Brazil. And that team is currently undergoing a project financing process with a targeted first production date in 26, 27, 28. So where do we sit today? In our view, when we think about this company, we feel like we've done a lot to diversify it. We've done a lot to deal with the immediate issue of the Kestrel roll-off. And from here, we feel that the key to achieving a premium royalty company valuation is to add more diversification, to really drive down the stock's beta, to drive down the stock's volatility. At the moment, market conditions are favorable to royalty partnerships. We anticipate year-on-year volume growth from 23, 24, and 25. Our portfolio consists of high-quality development royalties, which underpin our medium-term growth. We've recently updated our capital allocation framework and announced a $10 million buyback program. Without any further acquisitions, we foresee an accelerated deleveraging. And our portfolio, in terms of its commodity mix, is very strongly aligned with strong structural demand trends.
I think to start off, to let everyone know a bit about yourself, what was your career prior to Ecora, and how come, what was your journey up until Ecora, and maybe you could describe the outlines of your time with Ecora up until now.
Sure, I'm happy to do so. I joined Ecora over now. It's been 10 years. I joined in May of 2014. And I joined to get involved in the business development function and to really help with our diligence and execution of acquisitions. Before that, I was at Citigroup, where I worked in investment banking in the London team, in the London office, primarily focusing on natural resources, specifically mining. And before that, I was in Canada. I'm a Canadian, so maybe that's why I ended up in mining. I don't know. It's maybe just in my blood.
Excellent. And then we always ask the CEO of the company when we interview them, what's your personal allocation to the equity and alignment with shareholders? And maybe you can describe more broadly how you incentivize the key people also at the company to also be aligned with shareholders.
Yeah, I mean, the alignment comes in a number of ways, as you'd expect with a publicly traded company. Ultimately, our remuneration is, particularly on the variable side, fully aligned with achieving certain outcomes of growth. But as you'd expect, per share value metrics. So a big component of the remuneration package is tied to driving earnings per share growth. And actually, that's really our focus as a team. The focus is not actually to build the world's biggest royalty company for the sake of it. The focus is to drive earnings per share and NAV per share growth, which is 2/3 of our long-term incentive plan. I personally bought around 630,000 shares, which is maybe not a lot to some individuals, but for me personally is a huge concentration of my personal wealth.
Excellent, that's good to hear. And one thing that is always interesting with royalty companies, because it's a brains business, an intellectual business. Can you tell us about the corporate structure at Ecora? I mean, how do you operate this business? What's the process of reviewing royalties? Maybe you can take an example and describe how that process works for you guys.
Yeah, the royalty model is a business model that doesn't require a huge team. And if one were to look across the sector and across royalty companies, many are surprised by the headcount. We're just 12 people currently, and our team is staffed in terms of the deal side by 2 investment professionals and a head of technical. On the investment side, we have historically generated most of our acquisitions. In fact, bar one, every transaction has been a bilateral transaction. In other words, it's been negotiated between us and directly with the mining company or the seller, or the vendor of the royalty. We typically don't transact in sort of auction processes led by investment banks. Partially, that's just a function of the fact the royalty model or the number of royalty companies pursuing the commodities in our mix are just fewer. There are a lot of precious metals focused royalty businesses. In terms of publicly listed equities, there are 5 in the non-precious space. So it just tends to be less competition. Our opportunity, we run fairly rigorous technical due diligence, financial due diligence. Our investment process typically runs, 2 to 3 months. Can be shorter, can be a bit longer, depending on the opportunity. And our strategy is to be patient. I think if you look back at the number of transactions announced by Ecora in a year, it's been kind of up and down. And historically, I think anyways, part of our success has not just been a function of how many royalty deals we announce, but the quality of the royalty deals. So we haven't really shied away from going 5, 6, 7 months without announcing a deal if at that time there's nothing that we've really loved. We're really happy to be patient. And we think actually that just being patient and disciplined has really driven in large part our success and our ability to save our firepower for really high quality opportunities.
Prudence and patience is king in the royalty model, that's for sure. So it's interesting to me. I mean, can you tell us a bit more about that screening and kind of approaching mining companies directly, that early stage part of the process when you establish contact and say, okay, here, we're interested, can we play a part of the capital stack? How does that work? And how much of your time is put into looking wide at a bunch of opportunities?
A lot of our time, actually, because the commodity basket we target is quite broad. That being said, generally what we do by commodity and by stage of development, just to give you an example, is to say, okay, let's say we pick a copper. Let's say we pick copper as an example. We'll screen, for all the opportunities we see as potentially actionable. On the producing side, we'll screen for all the opportunities that meet our criteria, again, that we think are potentially actionable on the near production and so forth by stage of development. And then from there, we'll have long multi-year discussions with many of the counterparties. Not all will translate to royalty deals, but by doing so, we feel we really control, or we're able to position ourselves really, should an opportunity become available, to have relationships with the management teams, to be a known quantity, to explain how we work. And we feel that increases the probability of a successful transaction. In my opinion, if one is too passive in the royalty sector, in other words, just waiting for the phone to ring or waiting for the opportunity to arise, it's almost too late. So we do that, across the commodities that we target. And actually, many of the opportunities that we've transacted on, for better or for worse, don't happen the first time around. Voisey is a good example. We looked at the Voisey's base stream in 2018. At the time, we felt cobalt prices that were required to transact were just too high. We were patient, we waited, and then we had the opportunity to transact in 2021 at what we feel is a much more attractive long-term cobalt price in the range of $22 to $23 per pound, excuse me. So, we looked at that one twice, but we feel we were rewarded for being patient.
And then in terms of the due diligence itself, I mean, do you do everything in-house or do you outsource, for example, lawyer components, maybe some specific geological review or something like this? You have one technical person. I mean, how does that work within Ecora? Is everything done in-house or do you use consultants as well?
Yeah, I mean, first and foremost, as a royalty company, keeping our costs down is mission critical, right? And so we have developed in-house a great level of experience with royalty and streaming, both on the legal side and the technical side. And there's a lot that we can do in-house to keep costs down. That being said, when you think about how many commodities we review, if we were trying to in-house all of our technical capability and expertise, the bench would just be enormous. And the fixed costs of that approach would also be staggering. And so our strategy is to have really competent expertise in-house. So for example, on the technical side, but then on a project-specific basis to identify consultants as individuals who have really strong CVs in the specific commodity, in the specific jurisdiction, the specific metallurgy, to be able to access that expertise and that knowledge and know-how on a deal-specific basis, but also a variable cost basis to avoid having high fixed costs. We feel that strategy has been successful to date. Similarly for the legal side, we'll do a good level in-house and then work with experts as and when necessary, depending on the transaction type.
I mean, if we look at your portfolio, you have most of your royalties are with very established operators, serious people, and so on. But you don't have too many early stage projects. If we compare it to someone like Altius, of course they have a prospect generation business, so they have this in-house constant process of doing very early stage stuff, so that their portfolio has that big depth or base of a bunch of early stage projects. Is that something that you're kind of missing out on in this structure, or you something that you want to add in the future? I'm not sure. Could you describe that? Is that a correct assessment?
Yeah, historically, Ecora has not really been active in the sort of exploration style end of the market, if that's what you mean, at the very early stage, or at least not for the past decade. And I think there's probably two reasons for that. I think the first is, in the context of Ecora specifically, when we knew that Kestrel was going to run out at the end of 2026, we had sort of 10 years to 12 years to do something about it. Building a portfolio of long-dated early-stage royalties, it just wasn't the first priority. I mean, the first priority was to buy assets that were either in production or very close to production. So when the Kestrel runoff came, we'd have that stable baseline of income, or at least a level of income that was relatively similar to through the cycle average annual Kestrel contribution. From there, the next thing we did was add further growth into the business, but from assets that were much more advanced. We acquired a portfolio from South 32 in 2022, and that portfolio consisted primarily of West Musgrave and Santo Domingo, assets that were at the time, within 5 to 7 years from first cash flow. So, I think in time, Ecora could consider going earlier, but really the most important thing we feel is that to keep diversifying the business and to do it accretively, that requires internally generated cash flows. In other words, the less amount of equity we can issue and the most cash flow that we can recycle to fund acquisition is how we can best drive earnings per share and NAV per share growth. And we've, over the years, grown for example, a revolving credit facility from 10 million or less in 2014 to now 150 with an accordion to 225 million. So yeah, we tend to focus on the end of the market that's closer to first production or in production construction stage, simply because that does allow us to bootstrap further growth from the business.
So I think, what are the key points of emphasis for you guys when you are evaluating a project for investment? And obviously that's different for depending on the stage, but you can answer in the different categories if you want.
Yeah, funnily enough, it's the first point is always the same, actually. And really that's the quality of the ore body, because not every ore body is the same, right? Not every ore body is the same geological characteristics. And that includes, for example, location, grade, impurities. And all these things will influence, A, whether the project is likely to be built, or if it's already in production, at what cost these minerals can be extracted and sold, and thus the profitability of the operation. So, we really target defensive exposures, right? By virtue of being at the low end of the cost curve, generally those are defensive type ore bodies that can generate strong cash flows through cycle. And if they're not already in production, the best quality ore bodies have the highest likelihood of coming into production in the future. So in any commodity that we look at any stage, that's really the first and foremost the focus. And then, of course, there are other asset-specific considerations, right? Like location within a particular jurisdiction, like location in terms of proximity to established infrastructure. I mean, these are all really important considerations for a mining project. And then, from there, it's people. People are ultimately the ones, we're not, as a royalty company, the folks operating the mine. We're not the ones developing the mine. So we really look to work with strong management teams who are experienced, who have integrity. And then from there, organizations as well, organizations with know-how, with capacity to either develop and run mining operations, who are well capitalized through cycle. Of course, from there, we look at broader technical risks and considerations and flow sheets and everything you'd expect: provenance, title, ownership, encumbrances. A really holistic diligence review. I've mentioned as part of our diligence review on both legal and social and technical, we consider in great detail ESG style risks, which for us have always been kind of part of how we think about investing, but now generally are perceived as falling within an ESG bucket. And there's a lot of overlap between what we consider to be just normal practice due diligence and ESG style risks, particularly around the social and the environmental side. So to give you an example, by virtue of investing primarily into OECD countries, a lot of the risk associated with labor practices is minimized. And on the technical side, we've always reviewed permitting, water discharge, tailings. I mean, these have been central to how we think about diligence. So that's really integrated into our investment decision-making process. And then, of course, returns. We're looking to pay fair prices, but what we're not looking to do is to price a royalty at a price point which, through cycle is not repeatable. So in other words, we're not looking to price royalties at peak cyclical prices. What we're looking for is investments that through cycle have the opportunity to generate upside. And of course, that upside could come from pricing, but we also look for projects that have the potential to see mineral life of mine expansions, or see production upside that's not as included as part of the base case. And back to my starting point, frankly, great ore bodies in time typically get better. So that's one of the beauties of the royalty model.
And this is a very interesting point for me. It's the kind of the convexity that you can capture with the royalty model that's really beautiful over time, right? What's your process of trying to evaluate convexity in terms of optionality for exploration? And that's the ore body that you speak about, and of course throughput expansion consequently, and expanded cash flows. Is that something that you try to model in and try to make quantify, or is it something that you keep in the qualitative realm, so to speak? How do you approach that when you're evaluating, when you're creating your models during due diligence?
Yeah, really, I wouldn't say there's one approach, and I'll give you an example. So if someone were to approach us as Ecora and say, we're looking for funding for brownfield expansion, in those circumstances, I think it would be pretty unreasonable not to factor in the brownfield expansion, given our funding will specifically contribute to that production profile. At the other extreme, if we're looking at a project that's not yet in production, it's probably less likely that we'd be inclined to factor in as part of a value proposition up front the potential for an expansion thereafter, both in production or life of mine. So it probably, to answer your question, is situation specific, and comes down to some degree to the level of technical study that's been completed in relation to into what could be considered upside or what could be considered the base case, if that makes sense. But generally speaking, with our royalties, we're very focused on the reserve-based mine life, right? We're very focused on the production plan as it stands now, as per the latest technical report, and that's always our starting point. So with royalties, you really have two sources of upside, generally speaking. The first is production uplift, or in time, life of mine expansions. And we've seen in our portfolio, but already in some of the transactions we've done, longer mine lives. Mantos Copper is a great example of a mine, Mantos Blancos. The copper mine is a great example of a mine that has been in production for 50 years and keeps going. And actually, if you were to run spot cutoff grade prices or spot prices for the cutoff grade in the resource block model, I'd expect that you'd see a lot more mine life beyond the existing reserve-based mine life. So, the key is just to get good quality deposits. If one is looking for optionality, the good quality deposits typically offer a lot of that.
But I mean, do you attempt to say you have a great deposit that sort of seeking funding to build the initial mine? Do you attempt to model in that in a financial model? Try to put an actual value on that, because as we know when you do an NPV calculation, everything beyond 15 years is worth almost nothing. But obviously, for a royalty company, you don't have cost expansion. You're not exposed to the cost. So really, probably copper prices will be higher, say, in 15 years from now. And do you attempt to kind of model that in potential, some kind of growth in copper price and also continued operations? Is that something you try to do or evaluate like that, or is it something you keep in a qualitative realm? I guess.
I think it also depends on where you are in the commodity price cycle. So when we acquired some of our copper exposure, historically, spot prices were less than $3 per pound, and the market consensus was generally around $3 per pound. And that's what we priced that copper exposure. And we acquired the South32 royalty portfolio, copper long-term prices, we assumed they were around $3.40. So, really what we're trying to do here is get entry points where we foresee a lot of commodity price upside, either as a function of cyclical trends, but hopefully usually also a function of long-term demand trends. And actually our copper portfolio in particular, having acquired that at entry points of $3 per pound real forever and $3.50-ish forever, in my opinion, offers a fantastic upside just because of inflation. Right? We know that copper price is likely to grow with inflation. So I think that when you look at we have some disclosures at Ecora that give you a feel for what we paid for assets, how much we've gotten back, and what the net asset value is estimated by research analysts is. And when you look at that, what you can see is the assets we've had for the longest in our portfolio are the ones that generate the highest level of theoretical, mark-to-market total return. And I think that's by virtue of that's likely to continue by virtue of our investment strategy.
And I want to ask you as well, if you just describe what you believe to be your main competitive advantage at Ecora, or your competitive advantages to the other. You don't have too many direct competitors necessarily in the base metals and energy metals royalty space, but nevertheless, you also compete with other capital sources too. So.
Yeah. So there's really two sources of competition. The first is alternative capital, and you can put that as equity or debt, and the second is other royalty companies targeting the commodities we target. So focusing first on alternate sources of capital. The equity capital kind of comes and goes. If you were to take lithium for an example, right? Over the past 2 years, the equity capital available for lithium exploration, development, construction was sizable. And obviously that's really dried up in the past 12 months as commodity prices have come down. So that's really a transitory factor. And actually, because of our commodity basket is so broad, and because we pivot, we effectively pivot between commodities as and when there's demand for a product, which typically is a function of when there's less demand for equity, right? So that definitely influences what type of transaction we pursue. And then the second point is other royalty companies. And I touched on this earlier, but in our history, most of the transactions, bar one, which is an asterisk, started as a competitive process and ended as a bilateral transaction. These have all been between us and mining companies, which is unusual. If you look at the precious metal space, for the royalties anyways, it's vastly more competitive. But it's also interesting to think about the market. Precious metals is a small subset of the total value of minerals produced globally. So we're targeting a big universe by value with smaller direct competitors, and at a time when the demand for these commodities and the need for capital is growing very quickly. So if one were to forecast the expected demand growth rate just for copper, right, over the next 2 decades, very, 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 based on the research we've seen, it's a much higher growth rate than for precious metals, for example. And therefore, if one is able to achieve a smaller percentage, but of financing, but in a much growing market, there's a lot of space for us to keep getting bigger without having to sacrifice on quality, jurisdiction, returns to complete transactions.
Okay, so Mark, just set the stage before we get into the individual assets. Could you just, again, and you briefly covered this in the presentation, but just walk through the capital structure again to crystallize what the company is being valued at currently?
Yeah, it'd be my pleasure. Well, I think the first thing to note with Ecora is we have no warrants or options outstanding, so very clean capital structure in that regard. We have approximately 248 million shares outstanding. We just completed a buyback program, in which we bought up just under 5% of the share capital. So currently 248 million issued shares. That puts our market capitalization just around 200 million pounds. So with an enterprise value around $300 million US. And from a debt capacity, we have a revolving credit facility of $150 million. As I mentioned, net debt in the range of 80 to 90. So a good level of availability to grow. But we also have the ability to upsize that revolving credit facility by $75 million to a total of 225. So that's a good amount of firepower, we think, to keep growing the business without relying on equity issuances, which at these levels would be fairly dilutive. And while it's not an infinite amount of fire capital, Ecora is still a small company, right? So we're still able, within that context, to do bolt-on acquisitions that can move the needle.
Let's dive into the assets, and I guess let's just speak about Kestrel first. And the most interesting thing here, everyone knows the met coal project. You have a part of it as your royalty land. You're expecting it to be depleted by 26. But how much more cash flow do you think Kestrel will give you before it comes to an end, so to speak?
Yeah, that is the question, Garm. We have a really good feel for the volumes left in our royalty area, right? But the cash flow in large part is a function of the met coal price, especially because at Kestrel we have a royalty with that yields different royalty entitlements at different realized met coal prices. So at the highest end, at $300 Aussie, we receive 40% of any sale price above that level, right? And then as you go down in the price, well, we have half the royalty, so net to us is 20. But ultimately, that creates a lot of volatility in terms of the Kestrel royalty income. I think what's really interesting when you look at research analyst forecasts, and actually a slide that we showed earlier, which showed the expected cash flow profile from Kestrel in 24, 25, and even 26. In 24 and 25, there's an expectation for the same level of volumes mined in our royalty area. But research analysts typically forecast downward sloping prices, or have anyways, for met coal the past few years. And so if we're looking at a situation where from 24 to 25, you'd expect potentially flat or maybe even more volumes in 25. So whether one is excited about Ecora's cash flow prospects in 2024, 25, and to some degree 26 is a large function of where they see met coal prices being. And typically, research analyst forecasts of the past few years anyways have been well below actual realized price levels. And in that regard, actually, there's some really positive structural factors for met coal pricing, which is largely a supply constraint. And it's very difficult in today's world to bring new met coal supply online.
Can you remind everyone what's the met coal price sitting at currently?
Yeah, spot prices in the range of 225 to 250. In 2022, we saw met coal prices in excess of $600 per ton. We obviously in 2022 generated a spectacular revenue in that year. We generated 110 million at $600 per ton. That's a great outcome. We always knew that wasn't going to last though, and it hasn't. But even to 225 to 250, frankly, is still a very high level relative to where met coal has been historically. So while we're not at high, like extreme record highs, we're still at through cycle levels, which are still fairly robust.
So I'll push you a bit here. So if these prices remain throughout the rest of the life, what's the range of expected cash flows to you? Yeah, it doesn't have to be exactly precise, but just give us a sense. If the price remains where it's at now, what do you expect to get until depletion? And let's say it goes up to say the average will be 50% higher or something like that. What would you see then as a range?
Well, because you're pushing.
Yeah,
I can. We generally don't publish our own forecasts, but I can give you a feel for where consensus is, if that helps.
sure.
And so, this year for 2024, research analysts are forecasting in terms of consensus just over $40 million from Kestrel. And then in 2025, if you extrapolate that forward, given the volumes in our area are expected to be similar for those 2 years, you'd have to sum those numbers. And then 26, we'd expect a lower contribution as a function of lower volumes. So, you could be, if you assume for this year and next year anyways, 40 in each year, and then we'll see what comes in 2026 as a part of what's left in our royalty area.
What's the absolute amount of volume attributable to you in terms of tons of met coal? If you put it that way, so then people can calculate on their own, depending what they think is how much is left approximately.
Yeah, well, that's not that exact figure is a function of mine advance rates in terms of timing. So how much this year, how much next year, how much in 26.
Yeah.
It's also a function of yield. And unfortunately, and quite unhelpfully for investors in Ecora, that exact figure is not in the public domain. It's not a figure that we can disclose.
Sure. Okay. I guess that's all we're gonna get. But as we know, I mean, either way, this is what has been funding and what will fund a little bit more, in the coming years. Your transition here. So that's Kestrel. But let's go over to Voisey's Bay. You have the underground expansion underway. Could you kind of give you said that there was potential for essentially a doubling of potential revenue contribution. Could you give a sense of where we're at now and what you could see and when you realistically could see that happening? There's a ramp up process and so on. What's your view on this?
Yeah, so revenue is always a function of price. But I think when we see the potential to double or more than double, we're really talking about volumes. So, through at steady state, sort of life of mine average, that asset is expected to generate a total of, on average, and that could be up some years slightly, it could be down, 40 deliveries of cobalt, of which 70% are attributable to Ecora. Last year, we saw just over 10. So, when that asset really hits its stride, there's a strong expectation of volume growth. And similarly, from where we are from a price perspective, we've seen cobalt range from $15 per pound, where it is approximately currently, slightly higher on the alloy grade, which is what we receive primarily, to just under $40 per pound. So cobalt as a commodity is a small market. in compared to, say, copper, which is upwards of, call it 25 million tons per year. This is still a market in the range of 200,000 tons per year. So it's a very small market that can move up or down as a function of relatively small supply changes. So we do see potential for price appreciation as we look to the future. So not only is there strong volume growth potential, but also strong improvement on the price side potential as well. In terms of timing, as I mentioned earlier, the expansion really is approaching the sort of the end of the expansion schedule. We'd anticipate to see volume ticks up in 25 next year and the year after, and whether or not the exact steady state production is 26 or 27, we'll have to see. But we would expect a fairly steep volume pick up in the next 2 years based on the latest information we have available from the mine operator.
So when they reach that, let's assume they just stick at that kind of, as you describe it, stride, the production level, and you have $15 to $40 per pound price. What's the range of revenue contribution you would expect to see on an average year once they have ramped up? To give people a sense of
assuming prices in the range of, say, the mid to low 20s, that's somewhere between 25 to 30.
Okay, well, that's very good, obviously.
Yeah, and it's an asset that in our view it's been difficult, frankly. I think the timing of would we have liked to see a faster project schedule, of course. In some part, that schedule is impacted by COVID and just supply chain bottlenecks that persisted thereafter, which seemed to create sequencing issues. One thing is delayed, the next is delayed even more, and so forth. But it does feel that the hardest it appears that the hardest is behind us, and that asset really is close to hitting its stride. And it's a fantastic mine. I mean, I've been personally to visit it. A really impressive operation, and we do feel it has a lot more to give in the future. We're quite excited about that.
So just to clarify this for people again, see that we're not misinterpreting here, but what you're saying is that there's pretty good shot that Voisey's Bay alone could be sort of 10% of your enterprise value per annum in royalty contribution. Is that correct? In a couple of years from now.
Well, I don't know what you mean by enterprise value
value we established, enterprise value we established was currently around 300 million.
So you mean you're comparing today's enterprise value to potential annual contribution? Yeah, potentially. Exactly. Yeah, and more. It could potentially be more. I mean, as I mentioned, this is assuming cobalt prices in the range of mid-20s to low 20s. So that's generally the point where brokers have long-term price estimates. If you were to be very brave, I don't think it would persist forever, but there's certainly periods where there's potential that could occur, and to put prices in the 30s, which we've seen for a year or two at some point over the next decade and a half. We could see a lot more in one particular year.
So what are analysts valuing Voisey's Bay at on average?
The consensus for that asset is somewhere in the range of 150 to 180, in that range. Depends on which broker you pick. I mean, cobalt is an interesting commodity. Some brokers will sort of be less scientific about how they think about cobalt relative to copper, which is a much broader part of the universe. So you can see a wide disparity in research analyst forecasts. In the past, we've seen amongst the universe of research analysts, cobalt long-term prices ranging from 15, 16 to 30. So there's a very big range in where folks see this price going into the future. Not necessarily the most scientific across the board, but our entry point, as I mentioned, was in the low 20s. And if you think through cycle, if cobalt ranges from 15 to 40, the low 20s feels like a very safe place to be, with achieving our base case returns with a lot of potential for outsized performance.
Indeed. So let's move over to Mantos Blancos. Can you just give us a synopsis of the asset again very quickly, and then just speak about your view on the long-term potential of the asset?
Yeah, Mantos Blancos was our first copper royalty, and we bought that in 2019. It's an asset that has seen pretty regularly life of mine extensions. It's an asset that produces currently both copper it treats sulfide ore to produce a copper concentrate, but also is retreating oxide material and generating copper cathodes. It's a mine that has potential for more, frankly. It's one that we're really excited about in terms of its ability to extend the life profile of the oxide ore body. So if you were to look at the latest Capstone Copper feasibility study, the oxide material doesn't have a huge life, but there's definitely potential for that material to continue. And beyond that, there's potential to complete a second debottlenecking, which would see an increase in throughput of the sulfide processing circuit. It's a shame that we didn't have a chance to talk you through our copper growth pipeline, because that's a really, within a 2 to 3 year horizon, at today's copper prices, you would think a really attractive growth option for Capstone Copper. And then they've said similar things, in the public domain. So that's very encouraging.
In terms of Mantos Blancos, so what's the current range of production on an annual basis, and what's the at say spot price or whatever copper price you want to pick, the expected royalty contribution for Ecora?
Yeah, so this is an asset which last year produced approximately just over 40,000 tons of copper per year, both in sulfide and oxide material. Guidance for this year from Capstone Copper is 49 to 57,000 tons per year. So for the rest of the mine life, sort of steady state production estimated at 54,000 tons per year, and compare that to 22 production of 41,000, good amount of volume growth, and that excludes the phase 2 expansion potential. So financially, this is an asset which this year is expected to generate approximately, on broker numbers anyways, 6.1, but that certainly is not running spot copper price at 450. So there's a good amount of production upside, but also price upside from the Mantos operation.
And what would you think? I mean, there's a potential mine life extension here, and as we know, Capstone is an aggressive growth operator. They have multiple projects, they execute very well, so that's kudos to have several royalties with some of their main projects, right? But what do you think the expansion might look like? Is it a 30% expansion? Is it a 50% expansion? Has Capstone indicated what the potential outcome could be?
Capstone has spoken about it in terms of increasing the throughput rate. What they haven't done is given any guidance as to what that could mean for annual production. But what's interesting about having a higher throughput grade, of course, is that it allows for a lower cutoff grade. So in other words, more material can potentially be included in the mine plan, which might otherwise have been treated as waste. And furthermore, at today's copper price, you'd expect, even compared to 3 years ago, it's unlikely that someone would run 450. But one probably is, most mining companies today have elevated cutoff grade prices as a result of just natural increases in long-term pricing expectations. So what this means to us is that at a higher throughput rate, not only could you see higher production volumes, but you could also see longer production volumes as well, as the mine life is extended, as more material is economic to treat.
What has been the throughput expansion? What's the percentage of expansion that's been discussed?
In the public, I believe that they've referenced a range a figure in the range of 9 million tons per year, potentially, although we'll have to see. That may have moved around historically. So we'll have to see. Or that would be what, like 10 to 20% increase in sulfide throughput. But then again, it's not correct to simply say that because the throughput rate increases, production increases at the same percentage, in part because of the grade variability. So in other words, if throughput goes up, but then grade potentially comes down slightly, you might not see a direct read across and correlation between the throughput rate and in linear sort of way, and resulting in an exact match in terms of the output. of sellable copper products. So I think on this one, frankly, we just need to sit tight. The first thing to watch for at Mantos in this half year is the installation and completion of equipment that will allow the processing circuit to operate at full capacity. What Capstone has said publicly that, while they've recently completed a debottlenecking project, there are bits of the old circuit interacting with the new circuit, and there's work to be done to maintain a more stable throughput rate. Once they do that, and once the mine is hitting its nameplate capacity, the processing circuit is hitting its nameplate capacity consistently, they'll then look to complete the phase 2 expansion study. So that puts us on track for the phase 2 expansion study potentially in 2025 or 26. And until we see that, it's hard to give folks much more of a feel about what that phase 2 expansion could look like. I think what's much more tangible, which is what's directly in front of us, which is, compared to last year, for example, an increase in the throughput rate just to achieve installed capacity. In addition to that, an extension of the life of the oxide material.
So I'll go ahead and say it, but it sounds like Mantos Blancos will incrementally improve. There's nothing, no transformational change coming up in the next few years. But it sounds like it's going to be like 5 to 10 million US in royalty contribution. That's with a reasonable range for copper prices, and would sound like a reasonable figure from my point of view.
It certainly could be, right? It depends really on where you believe copper price will go and the pace at which they're able to get these units out of the ground. But no, it's an asset that we're really excited about, especially if you plug in spot copper prices.
Okay, so let's move over to West Musgrave. Obviously, a very significant asset for you. We know that nickel prices has been in trouble or under pressure. It's started to reverse now, but certainly was looking quite grim there early this year. And I would assume that's the reason why BHP decided to kind of slow things down a bit. Maybe I'm incorrect, but could you describe why that was from your point of view, and then also describe to people what kind of significance it will have for Ecora once online operation in terms of cash flows? Again, a range.
Yeah, so there's a bit of history here that's maybe helpful for context. So the West Musgrave mine was acquired by BHP as part of the Oz Minerals acquisition. And, one of the reasons we think this asset was helpful to BHP, it would create a more internally sourced feed material. And I believe BHP has alluded to approximately 30% of internal feed from this asset to be treated at the Nickel West smelting and refining division. And currently, Nickel West is not filled to capacity with BHP generated ore. Historically, they've also taken third-party feed material. So this would allow BHP to operate closer at Nickel West to 100%, but probably not 100% levels, but closer to their own material through their own processing circuit. And furthermore, that Nickel West, as we understand it, was designed for certain metallurgical characteristics of ore feed, which have changed over time based on their own nickel operations, and which West Musgrave would help. So this is really the iron to magnesium ratio in the ore feed, and the smelter, as we understand it at Nickel West, has been calibrated to a certain feed. And the West Musgrave feed would help keep that ratio low, which is important to Nickel West. So there are a lot of strategic reasons as to why Nickel West would make sense with West Musgrave. West Musgrave itself is a really low-cost project. It's estimated by sort of market research analysts. S&P is the figure we put out, but you can see similar things if you look at Wood Mackenzie or elsewhere. West Musgrave is expected to be at the very low end of the cost curve, in part because of it's at today's spot prices anyways, expected to be something like 50-50 copper nickel. So when you think about West Musgrave in the context of BHP, part of their decision to maybe slow it down is tied to what they may choose to do at Nickel West, which may be potentially to slow that operation down. And if that operation's not running, maybe they don't need the feed. But then on the flip side, you have a mine that's generating at spot prices anyways, as I mentioned, probably 60% from 50 to 60% nickel and 40 to 50% copper, depending on where you are in nickel and copper. So there's in our minds a very low cost asset that BHP has indicated publicly could generate strong cash flows through cycle, and even generate strong cash flows even at the spot nickel prices when they're around $16,000-$17,000 per ton. So it's a really great mine, and we'd expect that one to come into production at some point. The question is when, and BHP has alluded to a phased CapEx plan, so that could mean a year or two, possibly 3 delay. We just don't know at this time. We'll have to wait and see what BHP puts out publicly. But it is a good reason and a good example as to why when you buy royalties as a strategy, it's obviously, and I'm sure any royalty company you speak with will tell you this, to really target high quality assets. If West Musgrave were a high cost operation, the likelihood of that project being deferred or postponed for a much longer period of time would be much higher than it appears to be today.
So what's the in terms of the analysts that has valued this asset for Ecora's point of view, what are they what are they estimating in terms of it getting online? What's the average?
It's a bit of a range currently. The earlier folks are 27, 28. Some of the later folks are 28, 29. We'll just have to see. Helpfully, we'll have much more visibility from BHP themselves. They've indicated that they'll include in their results announcement in August much more detail around the timeline. And whether it's 27 or 26 or 28 or anything else, I think just having that visibility from BHP will be really helpful.
Okay, so we'll keep our eyes on that for sure. We'll have to talk again when that's out. So, can you let everyone know what the I guess copper and respective nickel production is expected to be life of mine average? Maybe you can let us know.
Yeah, I can.
If it's prompt poll as well.
Yeah, so this is a life of mine average. So I think for both, it's kind of higher in the initial years, which is great for the royalty investor and a mining company for that matter. But West Musgrave is approximately 26,000 tons of nickel per annum, copper approximately 32,000 tons. So if you assume long-term consensus prices, that's somewhere in the range of $15 million per year on average from that royalty. Now, long-term nickel is actually lower than the spot price today, which is hard to believe considering many people were very negative on nickel until quite recently. So on nickel, I think that's a pretty conservative sort of price level. And of course, long-term copper is still well below $4 per pound, spot at $4.50. So there's a good amount of upside to that annual portfolio contribution number I just mentioned.
So when you're saying $50 million, and that's at $4 copper and $3, what's the nickel price that's assumed in that figure? That's for life of mine average.
Yeah, so that $15 million would be long-term nickel, like $15 million for $15 million per year. That assumes long-term nickel in the range of $18,000 per ton, and copper in the range of $3.80 per pound.
Okay. All right. Well, that's very good. You have plenty of optionality there, and that's 2% NSR. And West Musgrave, if you just talk about the ore body briefly, do you see that potentially being expanded further out in the future? What's the longer term game for West Musgrave potentially?
I mean, what's really exciting about West Musgrave is actually when you look at that project and you look at its growth potential, that's actually really concentrated in copper. From an exploration perspective, there's 50% of the resource at West Musgrave. It's outside of the current mine plan, and that's all copper. So there's a lot of potential here to develop either in time a bigger, extend the life as a copper ore body, or potentially to bring that forward and upsize the annual production rate with more copper production. Oz Minerals, when they own the asset, studied the potential to potentially accelerate the Sukhoth deposit. Although BHP has, as of yet, not disclosed any further information on that front. But there have also, Oz Minerals did disclose a lot of exploration work they did around this West Musgrave deposit as well. So everything to like for here about, resource expansion potential, life of mine extension potential that we don't anticipate really anyone to put like substantial value on today, but it is really exciting optionality with that royalty.
Excellent. So let's move to Santo Domingo, obviously also with Capstone. Could you give us an synopsis of the asset again, and let us know what the expected contribution is when that comes online for you guys?
So this is an asset that, the first thing to like about Santo Domingo is that it's something like 20 miles or 30 kilometers away in a straight line from an existing Capstone mine called Manto Verde, which Capstone recently brought online materially on time and on budget, which in the mining sector is no small feat. And what Capstone has indicated, that they indicate the potential to take the exact same team that executed the Manto Verde expansion and use that team to complete the Santo Domingo project, which would be great from an execution risk perspective. This project has the potential to do, in our area anyways, over the first 8 years, in the range of 120,000 tons of copper. And our royalty area covers the first 6 to 8 years of production, depending on production rates based on the prior mine plan. There's an anticipation that mining would then leave our royalty area and come back in towards the end of the mine plan. That being said, our royalty area at Santo Domingo is the highest grade copper portion of that ore body. And therefore, we're fairly confident that, any mining operator seeking to maximize NPV would start by mining the royalty area where Ecora is entitled to its interest.
And what kind of, 120,000 tons, would that be the average production expected for this, 6 to 8 years for Ecora?
Yeah, so that would equate at long-term prices of, as I mentioned, just under $4 per pound. That could potentially equate to an average income over the first 8 years in the range of $25 to $30 million. All this is subject to the feasibility study update that Capstone releases in the coming weeks, based on their prior target to release it in H2. So this could change, right? The mine plan sequencing could change, but that's based on the prior feasibility study released to the market.
Excellent. And then the Santo Domingo longer term potential. If you speak here about the asset, do you see something? Your royalty land covers a portion of the deposit. Do you see potential exploration, finding more ore within your royalty land, or what's the situation there?
Yes, our royalty area does cover areas outside of the main pit. In terms of whether or not there's more to come, I suppose it's possible, but as of yet, we haven't seen anything to suggest that royalty we should expect like huge upside from, in the same way of West Musgrave, from exploration. Although I think we'll have to wait and see what we get in the updated feasibility study. We understand that Capstone has completed more exploration work in the area and are looking to optimize the mine plan. So it's possible that we see have a better indication of what may be upside outside of the main pit as part of the updated feasibility study.
Okay, so let's move over to Piauí. Same story there. Can you just give us a sense of the status there? Just give us a synopsis of the asset, what you feel that the expected contribution will be once in production as well.
Yeah, so Piauí is a nickel cobalt project in Brazil. It's effectively ready to go, so to speak, materially permitted, materially studied. And currently the management team is looking forward to complete project financing, which is one of two things that need to complete prior to production. First is putting together a financing package to fund the construction of the operation. And then number two, the completion of detailed engineering. We recently part funded through an upsize of our royalty interest, the completion of certain detailed engineering, which in our view is great because it helps, first of all, de-risk the project. But we have the right at the time of construction to upsize our royalty interest to a total of 3%, well, a total of 4% actually, which would then see us make a payment of $62.5 million to contribute in part to the construction of the operation.
Excellent. And what's the expected cash flows once in production?
Yeah, so that mine is expected to produce, on average, around 24,000 tons of nickel per year, and approximately 1,000 tons of cobalt per annum. If you were to run long-term consensus prices of cobalt and nickel, you probably would be looking in the range of $15 million per year.
Excellent.
Yeah.
And that asset, a bit more broadly, what do you see as the exploration potential more long term? Do you have a sense of that? Do you feel like it will age like wine, so to speak, as you see with West Musgrave, that potential like embedded into the project?
Yeah, I think at that one, there's less potential for exploration. It's a very long mine life. There appears to be less potential for exploration. The team has looked at what may be in the surrounding areas, although the mineral resource does really seem to be, and the reserve are concentrated within the core area of the project. So it's possible, I suppose, that with higher nickel prices and a higher cutoff grade, but that one would less likely to see substantial mine life expansion compared to, say, West Musgrave or Voisey's Bay or Mantos Blancos.
The next asset, I guess, and the final one that we'll discuss for now is Vizcachitas. So that's a very big, fairly high average grade project. You paid $20 million for it, and that's the most recent acquisition as of July last year, I think. Could you outline the kind of path to cash flows there and why you decided to make that investment? It's a long-term investment, right?
It is.
Royalty into a big production profile.
It is. And frankly, it's not often that we see really big, high-quality copper projects. So this is a 26-year mine life, and this one certainly has potential to get bigger, both above ground and underground thereafter. The existing the studies as recently completed estimate the life of mine copper costs in the range of $1.25 per pound. First 8 years of production at 180,000 tons per year, thereafter going to 150,000 tons. So just a really, really big operation. It is, slightly longer dated in the context of some of the exposures we have in our business. But then again, we think it really does complement our copper growth pipeline and our copper pipeline more generally. This asset, if you start our copper exposure with Mantos Blancos in terms of producing and then a potential brownfield expansion at Mantos Blancos, thereafter would be West Musgrave and Santo Domingo in the medium term. And then thereafter, we'd expect our nifty exposure to come in. And then next, in terms of sequencing, the next one expected today thereafter would be Vizcachitas. So Vizcachitas is big, it's complicated, and it's a type of asset that you'd expect. It's one of the largest undeveloped copper deposits in South America. So it's the type of asset that you'd expect a much larger mining developer to pick up and bring into production, if ever. It just feels too big and too complicated for a smaller company. And I think one thing that we really like is that we really like the current management team. We really like the board. And I think they're aware of the challenges of trying to develop this project themselves. So we think in time it's likely that this project ends up in the hands of a group that has experience operating in Chile and experience developing projects in Chile. And in time could be a really key part of our copper growth story.
Yeah, and obviously you guys have engineered into several clauses that kind of protects your investment, which are interesting. Maybe you can highlight some of the most important ones there, and also I guess let people know what the expected once in production with the current snapshot production profile, what the contribution would be per year. And
Yeah, so I mean, look, one of the hardest things about longer royalties is first production date. And so when we structured this royalty, we as of today have the right to a 0.25 NSR, and then we structured step ups in the event that the first production date slips. And if first production is not achieved by the 30th of June 2030, we'd receive an incremental 0.1% NSR entitlement, which would take our total NSR entitlement to 0.35. And then if hasn't occurred by 31 and 32, we would potentially see two further step ups. So we could see the royalty go from 0.25% up to 0.55%, depending on when the project comes into production. And Los Andes has the right, in lieu of two of the step ups and depending on the copper price, to make payments to Ecora, which if the copper price is above $5 per pound at the time, we could receive up to a total of 40 million to avoid two step backs. So this is one that we think works well for us in the sense that if it comes into production on time, fantastic. The operator receives a royalty and that's priced at a level that reflects that first production date. And if it's delayed, then our economics are maintained. So it's a nice transaction structure, we think, to de-risk uncertainty around first production date.
right, and it seems like it's going to produce, for a very, very long period of time, projects like this, but like and this is at current, say, $4 per pound, or just under 3 to 5 million US in royalty revenue per annum at say 160,000 tons per pound of production profile, somewhere around there.
Yeah, it really sort of partly depends on when you assume first production, actually, right? Because we have a different royalty rate depending on when first production occurs.
Exactly.
But if you assume first production occurs in 2029, for example, that would be 3-4 million. It could be a whole lot higher. It could be a lot higher, obviously, if production is delayed.
Yeah. Well, that's great. And I want to ask you more generally. We've spoken of some of the key assets here. Obviously, you have more producing royalties that is kind of in the 1 mil to half a mil per quarter cash flow range. But is there anything you would like to mention if we look at the other assets we haven't spoken about? You would like to highlight something important that you could see as a catalyst in the coming years?
Yeah, one thing that well, there are two things that really get overlooked when people look at Ecora. And I think it's a function of the fact that our P&L tends to be dominated by Kestrel at the moment, right? So our copper growth story just tends to be overlooked generally, and we've spent a lot of time speaking about the assets that sort of form the copper piece of our business. And another piece that's quite interesting is our uranium exposure. We have exposure to Cigar Lake through a toll milling agreement in Canada. We have exposure to a producing uranium mine called the 4 Mile Mine in Australia. And most recently, while it's still at development stage, still at exploration stage, we've seen some really encouraging results on a property adjacent to NextGen's Rook project. So there's a lot to like in our uranium exposure. It's not the cornerstone of our business, but it's a nice commodity that complements our holistic exposure to really the thematics I mentioned at the start of the call, which are renewable or low carbon energy production, transmission of energy, and therefore the storage or consumption of energy.
And then if we move over to the final kind of topic of discussion, which is your capital allocation strategy. In terms of direct returns, and I would kind of count in buybacks, dividends, and deleveraging as sort of direct returns in a sense to shareholders. At what valuation, at least if we speak about buybacks and dividends, or especially buybacks, at what kind of valuation, say enterprise value for Ecora currently, does that take priority over most growth investment that you could foreseeably or reasonably see? At what point is it more attractive essentially to buy your own existing assets than buying into new assets? Of course, you have
Yeah.
a diversification mandate and other considerations as well, but would be interested to hear your thoughts about that.
Yeah, I mean, look, I think it's a relative question, right? So ultimately, that question and the merits of a buyback or growing the business by royalty acquisitions depends on the differential between where estimated net asset value is and where the share price is. Ultimately, the royalty companies with the best royalty sector ratings tend to be those that are highly diversified. And so at the extreme, if one were to simply do buybacks, you ignore the merits of further, and you don't get the benefit of further diversifying the portfolio contribution line of the near-term development portfolio and so forth. We recently announced a buyback program simply because we felt that the differential between market price and net asset value is sufficiently wide that it was relatively very accretive, both in terms of earnings per share, dividend per share, and net asset value per share. We'll consider buybacks in the future, but at this time, we're not looking at another buyback program. Our immediate focus is to further grow and diversify the royalty portfolio. That being said, as part of our capital allocation framework, we've signaled quite clearly that we would consider buybacks in the future, subject to where the equity is trading and where net asset value is estimated to be.
So, kind of a broad question, but how much capital do you think you would need to allocate? But since 21, you've allocated approximately 400 million US into building out this portfolio, which is impressive for sure. But still, how much do you think you would need to allocate, or how many to reach a diversified enough point where you would kind of see similar value, multiples as your peers in the base metals royalty group? How long do you think that would take, and how much capital do you think would need to deploy to get there?
Yeah, well, I mean, if you just look at the current growth pipeline and the current the near-term royalty portfolio, this business will see basically vast majority of its cash flow ties to base metals in 3 years. So we wouldn't need to deploy anything to achieve that. That's already the base case, so to speak. The question of how much is currently is really the key question in terms of what that revenue line looks like and when. That will largely be influenced by the timing of West Musgrave and Santo Domingo. So in the next 2 months, we should have much more visibility on what that top line portfolio contribution looks like in terms of quantum. But the complexion, from a complexion perspective, we don't need to deploy anything to achieve primarily base metals cash flows in the next few years. That's just going to happen as the met coal exposure runs out and runs off, and as mining operations move out of our royalty lands by the end of 2026. So, the question is less around how much more you need to spend to achieve base metals exposure, but how much more you want to spend to further diversify the portfolio. And then it comes down to, I think what we deploy will be a function of how we can finance it accretively. Because ultimately the goal, in my opinion anyways, is not to build the biggest royalty company for the sake of it. The goal is to buy royalties that diversify the business, of course, but also drive earnings per share and NAV per share growth.
Yeah, I mean, obviously that's what shareholders want to hear, and I think you have a track record of doing that, which is why we're speaking to you today. But I mean, my question is not really in terms of diversifying into another commodity necessarily. It's more like you have you have like 5 assets that are going to make up the vast majority of the revenue. So when you look at the royalty model, I think some other companies that might be your peers have a bit more diversification in terms of how many assets are contributing to the royalty, to the revenue. I mean, what's the actual main thing you think the market is actually concerned about? Because you're being valued a lot less than compared to your peers. It's just that these assets are not online yet, or is it that they want to see something else? I mean, more diversification, even more assets in general, even for the long term. What's your take on it?
Well, it's to isolate a single factor, hard to do. But from what I can see, it appears that the market is, just uncertain around the timing of the development assets, and is therefore being quite conservative in terms of allocating any value to assets that are not yet in production, right? So I don't think you necessarily need to deploy more capital. I think what you need there is just time for those assets to be de-risked. And in my opinion, I think should those assets be increased, like incrementally de-risked as and when we approach, first production dates, I would have thought that those assets would see a lower risk factor. So today, for example, if you look at our development portfolio, that risk factor is basically zero. You take the value of the development portfolio times zero to it, add the producing portfolio, and that's kind of where you get to in terms of enterprise value. So I think that as the development portfolio is de-risked in a world today, which appears to be, relatively, copper prices are buoyant, yes, but equity valuations, the mining sector, certainly not, as you go down the size scale, not at all peak levels, absent arguably directly copper producers. So I think it's just a matter of time, really. And I think that when we think about the last 4 years, Ecora has really been in a transition period, right? So you think about 2023. 2023 was the beginning of the transition away from Kestrel, and the ramp up and the de-risking of the assets that will materially replace Kestrel, but that drive growth thereafter. So the past 18 months have been a period of time of the first half of the transition, if you will, and I think the next 18 months will be the second half of the transition as we approach the end of 2025, at which point I would have thought we should have much more confidence on the timing and certainty around the development portfolio, which I would have thought in itself should contribute to a valuation uplift if we see it materialize in a positive way. So we're trading roughly 1 times NAV of the slightly less, according to research analysts, of the producing portfolio.
Right.
And then zero on the balance. So,
okay.
Or you can do the math and just take the whole portfolio, and then if you take the entire net asset value estimate, then we're probably trading closer to half of the value, 0.5. But I do think it's actually kind of interesting when you think about that calculation, and that, when you think about what you buy with Ecora, if you look at the net asset value estimate from brokers, which include development portfolio, you pay 0.5 of the net asset value as estimated by research analysts. But that 0.5 represents entirely producing assets. So that's instrumental to the risk reward profile.
But generally speaking, it sounds to me like you believe that just time will be sufficient to kind of get you to a more reasonable trading multiple. As these assets come online, the market will view you in a much different light. Kestrel is out completely in 3, 4, 5 years from now. These other assets are starting to come online and significantly contribute. Voisey Bay, etc., Santo Domingo, and so on. These assets are online as a nice cornerstone for the company, and you feel like you don't necessarily need to be super aggressive with trying to find even more kind of shorter term, say within 5 years, production or cash flow timeline assets. Is that a fair assessment?
No. I would say that I think that the development assets in themselves will get more value as time comes. But that's not the same thing as saying that we intend to just sit on our hands and do nothing for the next 5 years. I think that, especially in this commodity market, the next 2 years should, and have already in the context of equity market conditions of this year, have presented some interesting opportunities. So while we're not in a position where we need to do transactions at any cost, I still feel that by further diversifying our portfolio over the next 3 to 5 years, we could further improve the company's valuation and the share price. But I don't necessarily think it's the same thing as saying we should do nothing and just let those assets de-risk. I do feel if that strategy would be very risky, because actually I feel like we're in a window now where we can hopefully buy some good quality assets at fair valuations, which may not be available if equity markets or generally sentiment is significantly improved from where it is today.
Okay, so sort of middle of the road, but you're seeing a good opportunity now. Can you speak about what kind of opportunities you're seeing? Is there a specific stage? Is it mostly finance to get into production? Is it earlier stage? And what kind of ticket? You did show what kind of ticket items you were, or tickets you were willing to, or checks you were willing to write for investments. But generally speaking, could you share with people where you're seeing most opportunity currently for Ecora in the coming years?
Yeah, it's not too dissimilar to what we've already discussed. I think what we're seeing, and it's probably a function of what we're also looking for as well, but in terms of producing assets or assets that are at construction stage, ticket sizes in excess of $25 million for projects that are near production but not quite there yet. Ticket sizes in the range of 10 to 25. And then for assets that are sort of longer dated, more than 3 to 4 or 5 years away, ticket sizes less than $10 million. And we're seeing from a commodity perspective, a good mix across the basket that we target.
And what kind of debt? I mean, you have 225 available to you in debt, and you have $90 million US in net debt currently. So what's your thinking? What kind of debt are you comfortable with? Debt level are you comfortable with?
I think, look, as I mentioned earlier, we really use a revolving credit facility to fund acquisitions. So, and I think we don't really see the debt level as kind of the industrial target leverage ratio as one you might see in other industries. We would anticipate higher leverage ratios as when we transact, with a view to an accelerated deleveraging program thereafter. So we have capacity to acquire assets with our balance sheet. I think that puts us in a good position currently when you think about capital market conditions. In other words, if we were relying solely on our share price to fund our growth, it would be more challenging to fund accretive growth. And I think that whether or not we'd be willing to take on debt, and the quantum of debt is also a function of the asset stage and development. So in other words, we'd be more comfortable taking on large amounts of debt to buy a producing royalty, which is relatively de-risked. We'd be less comfortable taking on large quantums of debts for long-dated assets, right, that don't really materially improve our debt capacity.
Sure, and I would assume that equity is not, only in very rare cases would that be part of your acquisition tools, so to speak.
Yeah, well, I think we've demonstrated recently with our buyback program that at these levels we're buyers of equity, not sellers of the equity.
Yes. All right, Marc. So the final question that we always ask is, what's your 5-year vision for Ecora? Where would you like to see the company in 5 years from now?
Yeah, I think we have, I've been with part of this company for 10 years, and I think what we've accomplished in those 10 years is, just building a business that has longevity past Kestrel, and that has a good amount of growth in it, but it's just not sufficiently diversified, right? And over the next 5 years, really, it's twofold. I think the first is, to drive diversification with acquisitions of good quality assets, of royalties over good quality assets. And I think that if we can continue to further diversify our business and add scale as a consequence, that Ecora as an equity, it's fairly uniquely positioned to offer thematic exposure to the energy transition. Today, there's not really any company bigger than Ecora targeting these commodities with our portfolio composition. And there's a lot of white space for us as we continue to grow to become, a de-risked way for investors looking for low volatility, relatively low volatility, or relatively lower beta allocation to that thematic. And in the same way that a lot of people tend to get exposure in the larger precious metals royalty companies instead of, say, a precious metals ETF, or investing directly into a precious metals producer, if we're successful in adding more scale and diversification, I think that there's really potential for Ecora to equally become a sort of go-to vehicle for, relatively lower risk energy transition exposure. So that's the opportunity for us. But we have a lot more work to do before we can get there. And that's something we're very focused on delivering.